Oh God. All right. Yeah. All right.
All right. Yeah. Wow. That intro, man, it just makes me want to like dance and everything.
The kids call
Uh,
that EDM.
oh,
How's it
okay. Here
going,
we are.
man?
You
It's been a
guys know
while.
me and you know me. How you doing, CC?
Good, good. How was your Thanksgiving and all?
You have to ask.
The Michigan. I
Yeah.
watched it.
Yeah. It was great family week. My sister came in from New Jersey on Tuesday, and great Thanksgiving. Unfortunately, my Wolverines let me down, but I didn't have the high expectations.
No. And how many
I
years
don't,
had it been?
four in a row.
Yeah, exactly. So
Yeah.
it was going to happen at some point.
Yep. And
I
how
did.
was yours? How was yours?
So I was back east, do a couple of things. One was looking at colleges and all with my daughter, which is nuts. She's a junior. So, but I grew up in Baltimore, so I was back in Baltimore and took my son to an equally depressing Ravens Bengals game. So that's not to mention that it went till like midnight. But that was just like a weird game. The Ravens play the Steelers this weekend though, so they can get back on track. We'll see.
All right, so we can't let sports dominate our life like we let the markets dominate. So you've been putting together a pretty consistent view of and perspective on the markets. So with no further ado, let's get on following the CC Lagator options unchanged process.
Yeah, so it's interesting. We like to start the show every week with a look at sort of what the options market is pricing out for the next 5 trading days. And we've got that slide for this week, which is the expected moves in SPX and SPY and Q. Now what's interesting here is we've obviously just what we just experienced was wild since the last show we did. And what's if you look at these expected moves, so this is about a 0.5% expected move in the SPX every day, a little bit more in Qs than IWM. And then for the week, we're at about 1.4% expected move over 5 trading days. That's pretty low. It does get a little bit lower. The lowest you'll see in SPX 1 week expected move is about 1.1%, let's say 1%, in the middle of the summer or Christmas week for, perhaps in the future. So this is about half of what we were the last couple of weeks during all of that volatility. We were looking at daily expected moves over 1% in SPX. I think they got as high as, almost 2% during the, when the VIX was up near, in the high 20s. So now everything's ratcheted down and we got that bounce. It's been what, like a 5% bounce since
Nice.
Fridays, since last week's or 2 Fridays ago. And the options market now is basically pricing in that year-end Santa Claus grind higher, at least for the moment. Actually, it's pricing it all the way out. There's a couple interesting things that happened before year end, and the biggest one is what these expected moves just barely capture, which is next week at this time we're going to be 20 minutes away from an FOMC decision. And to me, that's been, if you think about that last Fed meeting where they cut and then they kind of poured cold water on the expectations for future rate cuts, you could argue that that was the beginning of all of this, recent volatility that we've seen in the market. And it sort of it killed the momentum trade, right? It killed, it might have killed like the Bitcoin trade and everything around that, all that momentum that we had going into that last Fed rate cut kind of got taken out, and everybody got taught a lesson real quick in those next couple of weeks after that. So now here we are. We find ourselves in an interesting situation where the Fed funds futures have round tripped from 80 to 30 back to 80, whatever we're at today. And it's sort of feeling like if there was if this options market is wrong, they're going to be probably wrong in those days after that Fed meeting, because if the message is the same, which is we're cutting, but no promises for the future, data dependent. I mean, they're not even going to have all the data yet. A bunch of data comes in after that, I believe, like the updated inflation numbers and all. So if that's the case, that will if something derails the Santa Claus rally into year end, it's probably going to be that day and like the end of next week, and the reactions Thursday, Friday. So that would be the only thing. The options market is not that worried. There's a little bit of a bump. So if you want to go to my
Sure.
chart, you can talk a little bit about, over the next week.
Do you want to go to this one?
Yeah. And
Okay.
so, we're looking at SPX. Let's go out into, basically year end. This is very low volatility now, for considering what just happened over these last couple of weeks. This is a month in the past. Like, look at these moves. This is, talking 4-5% moves back and forth. This craziness, right? And then all of a sudden we flatlined for a couple of days after this big bounce, and the options market is essentially saying, all right, it's all done. Now, there's one thing about that, though, is when the VIX was 28, when the market was down here, 5% lower, everybody's buying puts, people playing for a bounce are buying calls, and then you get that bounce. Now, all of a sudden, all of that premium that was bought, whether it be calls or puts, when the VIX was 25, now that the market is stalled up here at this 6,800 to 6,850 level, everybody's now turning around and becoming sellers of all that premium, because they want to either take their profits if they were right on the call side, or they want to get rid of those puts before they go to zero, right? And so that's the effect you're seeing right now, is the VIX, it's just down a little bit more every day. That is the sound of thousands of traders turning around and selling all the options they bought in the prior 2 weeks. And that can have a stabilizing effect on the market, which we're seeing, but it also can start to misprice the future. And we're probably into that now, where, next week's Fed meeting,
Yeah.
we
Well, is it? Don't we
SPX
get to
goes
see?
like 12.
Don't we get CPI data before that?
We get what do we get? So we get PCE on Friday, which is delayed. It's September.
Everything's messed up.
Yeah, and then I was looking a little bit earlier today to try to figure out what all is happening next week, and I think a PPI comes out. So the CPI is usually in tandem, so that'll be fresh data. And so anyway, it's sort of like the options market is really good at sort of pricing out the next couple of days and the
It's actually not
levels
to
of
the
volatility.
18th. It's not till the 18th.
So it's after the Fed meeting, right?
Yeah.
So you kind of get a sense of what Powell's going to sound like. And last time the market did not like it. So if there is a bearish reaction to that meeting, options are suddenly underpriced, I guess, is the big picture.
I mean, everyone's banking on the Santa Claus rally. The Fed will be out. I'm following your train of thought here exactly with what the Fed's going to do. Who knows if they have that CPI number under the hood. But yeah, it's been a fast market in that, in the Fed funds rate, the CME tool. The market's getting what they want. They're getting what they want. The little Microsoft kick in the butt things didn't happen, but I mean, there's always something picking up the slack. And one thing, that is, to pointing to the positive, is that it's more of a broad-based rally. It's just not the
Yes.
mega cap tech, and that's what people have been clamoring around for a long time. I mean, I even looked this morning when we had that vicious Microsoft sell-off. IWM was in the green.
Yeah.
Yeah.
So it's funny. I was thinking you were going there. So, this is obviously a monster rally in IWM, but it's like, it's right back up to those highs. So it's broad based without the level of insanity yet that would make me, say we're near another top. I will say, and we've been talking about this on the show, going back a month and a half, that 7,000 level, like you and I have talked about that 7,000 level in SPX is going to be extremely difficult to take out by the end of the year. And the reason for that is during this entire rally, look at that, this leading up until this moment, everybody has been targeting that 7,000 level. Like as soon as the market looked, like it was going to go to new highs and all, and we're only like up 15% on the year or something only, but everybody's been targeting that 7,000 level, and it is massive overhead supply, not only in the options market, but it is massive overhead supply in year-end price targets, and just where hedge funds have set up for a year-end Santa Claus rally, etc. That 7,000 level is probably not going to be breached if we do rally. And therefore, when you look at a chart like this and you look up at 7,000, you say, all right, well, that's my year-end target to play for. That's only 2% higher from here. So your risk, you have to start thinking about your risk reward is like, how do you, if you're positioning into year end, how do you position for a 2% rally into year end while being wary that you could go down 5% again very quickly? And so your risk reward has to look like that. And we've talked about, I'm just going to go to a little bit of a trade update here.
Okay.
So we talked about this trade, I think. When did we do this? A couple of weeks ago. So this is a way when I see a big spike in volatility, and you're looking for a capitulation and a bounce, that spike in vol in the options market lasts for a couple of days, right? I mean, it's coming down, but it's still high, right? When you're going from 28 VIX, you're going to be your first stop's going to be 22, your next stop's going to be 19. So when that's happening, you still don't really want to go, get too far over your skis and buying a bunch of really expensive calls, because they're still expensive from all that volatility. So we talked about this trade, which was, an iron butterfly, or you could do, it's basically trying to position for a move higher with as little premium risk as possible, and slightly short options, short volatility, short overall premium. And so this is the trade we looked at a couple of weeks ago. And it's basically, you can think of it as a 700 SPY price target, risking a very little amount of money to really have a outsized profits if the SPY is up around 700 into year end. And that's this trade we talked about, and it's doing great. It's up like 21%. And what I would be doing is like, as you get closer and closer, if we're up 1.5%, I'm starting to think about maybe taking this trade off and trying to take those profits, because I think at some point that rally runs out of steam right around 700 in SPY. One I did recently, and I know you all talked about this on the show this morning, is it's been crazy in Bitcoin. It's been crazy in crypto, right? So, Bitcoin was 125, went down to, basically almost 80 the other day. You got that first bounce and that seemed like it. And they were like, nope, head fake. And we're looking at IBIT right now. It was a total head fake. So yesterday I was like, oh man, Bitcoin is finished, right? After that bounce failed. And then I'm looking at, you guys were probably talking about it. Everybody's looking at like MicroStrategy's cost basis, which is only like 74,000 in Bitcoin. It was getting close, right? They were about to be underwater on their cost basis. So everybody's looking at that. It bounced again. I don't know if it's real. It seems a little bit more real. So I've put on the same position into year end that is basically positioning for a 100,000 Bitcoin, right? And so the corresponding, this is roughly, so that would be my center in this trade, and my big profit happens at 57 in IBIT. And, again, risking a little to make a lot. And those are the kinds of, positionings that I'm looking at into year end, where I don't want to extend myself and buy a bunch of premium. I kind of want to be on the other side of it, but I want to play directionally into year end. And this is, I'm risking as little as possible because this is what everybody thinks is going to happen. The Santa Claus rally. I'm making sure that I'm not overextended in case, it's weird to be on the side of everyone, and risking a ton on that because something bad could happen, like the Fed meeting next week.
Could you review that SPY trade for
Yeah.
Johnny Smith in the chat?
Yeah. So it is, in this case, I did it as selling a put spread and selling a call spread to the upside. But you can do it a number of different ways. The easiest, if you're doing directionally, the easiest way to think about it is, let's say you were starting fresh right here. You could buy the 685 call, right? You could sell 2 of the 700 calls, and then you buy 1 of the 715 calls, which will be like pennies, right? And what you've done is you've created a trade that's much less expensive than buying a call. It's even less expensive than buying a call spread, but you've really called your shot at that center strike where you've sold 2. So once it gets to 700, that's your max gain level, and you want it to kind of expire right around 700. If it starts going through 700, you actually start to lose some of your profits. And you can kind of see that here is, if SPY were to keep going here for a little bit, my profits increase. But then once you get up here, if it starts going through that, they start to decrease. So the worst thing that can happen for this trade is SPY goes lower. The second worst thing that can happen for this trade is SPY just goes up 5% in a straight line right through this trade. So you've kind of called your shot, and you've created a profit zone where the middle is where your max gain, and in this case, 700. So hopefully that explains it.
Yeah. One thing that's been symptomatic of this market, it's just grinding. It's just a grinder. It seems to hit these levels. And then grind for a couple days. But no, that's a good explanation.
Yeah, and if you were just doing, well, let's look at Qs because we haven't talked about that in a while.
Just real quick before we finish up that follow-up question, what would you do if it blew through the middle?
So I would take it off if it looked like that. So if it got up to 700, and you can sort of see if it got up to 700, let's say before the Fed meeting, and you can sort of see what this would be worth. It would be adding another 10% of profits or something. And I got nervous right after, like, let's say the reaction to the Fed was a blowout and this thing starts ripping to 705. I'm probably taking it off for a profit at that point. But if we get up to 7, if we kind of enter next week and we're 690, let's say, and then the Fed cuts and the reaction's great and we go up to 700, and at that point we're getting close to the Christmas break where volumes go down and the trades get the day-to-day trading gets a little bit more boring. I'm probably waiting it out, and I'm probably letting all of that extra premium come in. And because this is the type of trade where you're risking 6 to like make 19, You know what I mean?
Yeah.
So it's a really good risk reward. And the longer you wait on it and the more patient you are, the more of that you're going to see. But if I got spooked, I would take it off and it would be a great profit at that point.
Okay. All
Yeah.
right. Let's go to your final slide here.
Yeah.
Trade types for anticipated action here. That's very neatly done here. Let's run through these different scenarios.
So this is basically, this is what we were just talking about is the segue into, and it's like, people will ask me or, what strategies do I use? Right. And we've talked about it a million times. Very rarely am I just buying a call or a put. I'm, 75% of the time I'm doing some sort of multi-leg options trade. And a lot of times I'm selling options. I'm a net seller of options or a net seller of premium. In this case, I wanted to talk about like sort of directional positioning. And that's those, if you think about the SPY, we did that 2 weeks ago with volatility really high, right? And so I'm like, I want to position for a bounce, but I don't want to pay out my what because volatility is really high and all the options are overpriced. If I get that rally, vol's going to come in. The last thing I want to do is own calls when the vol's collapsing on a rally. So you could be right,
Yep.
and then you're wrong because the options market's so efficient. So the only way to take advantage of that is to be like positioning net premium or as little premium as possible. And so that's the directional butterfly we were just talking about, but at least do call spreads and all in that position. So if you've gotten a bounce, volatility is high, at least sell something against what you're buying. You're positioning for it to go higher, sell something where you think it's going to go. Sell that 700 call against the 685 call you're buying. So that's that. After, if vol is really low, and we can kind of talk about this. So let's say, what you and I were just talking about with the Fed meeting. And let's say you really want to either protect into your end for what could happen, and we could have another bout of volatility like we just saw because Powell's going to say what he's going to say. In that case, the VIX is 16. So it's, I'm probably still in the camp of like, at least planning to, if I was buying a put, at least planning on selling something against it if you got your move lower. But if the VIX is sort of 16 and below, like 13 to 16, you're probably safe if you're bearish to be just buying outright puts. And then you can kind of decide on your level versus your, kind of risk tolerance. Is it a hedge? Or if you are outright bearish, you might want to be more aggressive and closer to the money. But if volatility is already high, and let's say last week you were panicked and you were terrified, in this scenario, you absolutely you don't want to be extending yourself and just buying straight puts with the VIX at 26. You have to be spreading that, right? In this case, now that we've bounced and going into year end, we could look at this stuff. So let's look at the end. Let's do
What's
December
what expiration are you using on that SPY trade?
So the SPY trade is, let's go back. It is the December 26th expiration.
Oh, okay.
Yeah. And we did it November 19th or 20th.
So some time.
Yeah. And this is, so it's the same thing in the Qs. Like if we were to look at that and we were to look at, out to like, let's look at December 26th as well. Let's say you were bullish. I would absolutely be doing something that sold this prior high or something, close to it, which is 635. Or, you could go a little higher. You could say 640 or something. But in that case, well, let's say 640 or 650, because if we did get that rally to 7,000 in SPX, we're probably getting, a 3.5% rally in the Qs, take you up to like 645. So if you were bullish, I would at least be doing a call spread. This is buying the 623, selling the 645, costs you about $9. Not great, but that I would really think about doing the same thing we just talked about in SPY, which is a butterfly. if you were bearish in this and you wanted to either protect or position out into year end, I think you could probably at this point, let's go out same expiration. I think you could kind of be doing puts here again. I think vol has gotten low enough again. And, maybe you do, let's just look at like a 620 put. So a 620 put costs you $9, a little brutal. Let's go to a put spread. And then anytime I see $9, I just get nervous. I start to like sweat. So let's look at, buying the 620 and selling the 600. Let's say that, right? That takes you not quite to last week's lows, but if you got a reaction down here, what is that? That's about a 4% pullback, which could happen easily, right? You're talking about a $5 trade here. So, you look at that on a longer term chart, that's the kind of trade I would be looking at if you're spooked, and maybe we're a little higher into that Fed meeting, you get even better, higher strikes. But that's the kind of trade I'd be looking at. You could play around with this and take it down to like, give yourself a little bit extra room to like 595 on the one you're selling. That's a $6 trade. Your break even is 614, which is nothing. So that's the way I would be looking at like kind of year-end trades in all of these, ETFs.
Okay, I asked for tickers and I got tickers, so we may stay here, another minute or two here. A popular one seems to be Meta. In turn, is looking to protect the long.
Oh yeah, I agree. So let's just look at this. An entry here is very important, right? So if we are, we bounced back to here. This is a 5-year chart we're looking at, right? So we're about, how far are we off? That's 800. Okay. So assuming that this is to protect a long, let's go out sometime. And let's go out into, I don't know, February. And then let's look at some put spreads. All right. So let's look at this in a 1-year chart and see what it's spun up, and then we can play around with it. So that right now, it produced a 645, 565 put spread. Let's play around with this a little bit and make this 640. Or let's go like 625. And let's make this 525. All right. So this is about 20. This costs you $25, right? So that's a break even right at 600, which we clearly just tested to the downside right here. So you can see this break even where it goes. I'll zoom in. Where it goes from red to green. This is your break even. It's $599.60 on this trade with live prices, but call it $25. This $25 protects you basically down to 525, which is, let's pull up a long-term chart. So 525, that gets you down to some pretty important levels. You could maybe go a little bit lower and make it 500 of the put you're selling, but it gives you protection for all of this nonsense that we just saw. But what it does is you're spending $25 to stay in the stock for the chance this thing goes back to 800, which is 150 points. So I would see this as the way to think about a trade like this is, what are you willing to spend to stay in this stock to get it back to all-time highs? And that would take you out to February. You could go out to March. You could do whatever. But you're spending $25 to potentially see a 150-point rally. And that's the way I would think about that risk reward.
Yep, getting some protection on the downside. How about AMD?
All right. I haven't looked at this one in a while. What's it been doing? So
it's had a nice bounce. Hasn't been able to get halfway back of the move, but it had been holding up pretty well, trying to clear that 50-day.
It didn't do an Oracle, that's for sure.
No.
Right? So Oracle got down to like here. All right. So, and what's the question? Is it bullish, bearish?
I assume it's either to protect the long. I mean,
Uh-huh.
I think that would be the best way to approach it.
So to me, it's this gap fill, right? So you'd be looking at something down to, let's call it the 175 level, maybe 165 or something. So let's do the same thing. Let's go out to February and look at some put spreads. So this is a 220. Let's do 220. How many points is that? That's two. Here's an interesting one. All right. So this is a 200 175 put spread. Costs you about $7, and it protects basically $18 to the downside to that 175 level. And if we look at this on kind of the 1-year chart, I like this. You're protecting this gap. Do you see that, Joel? Like,
Yeah,
you're like, all right, if this thing pulls an oracle, I'm pretty much protected for that entire portion of the move, right? And if it actually did that, I'd probably be, I mean, depending on what's going on in the market, there's going to be a lot of buyers stepping in an AMD down here. And so you're protecting for that move, and you're giving yourself bullets that if you were long-term bullish on AMD, you could be one of those buyers down here. You wouldn't be a panic seller. You would actually be like, I've been good from 193 down to 175 in this, and now I'm a buyer again. So I would think something like this. This allows you, to 50 points to the upside. You're risking $7, maybe $8 to the downside to be able to sleep at night.
All right, let's go to the CAT.
Wow. All right. This is a $600 stock. It's one I don't look at very often.
No.
I mean, look at that. So what is going on with that, Joel?
AI trade.
AI and CAT? Like everything's going to be automated or something?
Yep. No, digging.
Oh, that's what it is. Oh, okay.
Building
so it's all the data centers.
building the data centers.
Okay. All right. So, all right. I mean, yeah, I would be absolutely 100% protecting this. So how many data centers can you build?
And the tax bill too.
Yeah. Okay. So that's when I haven't been paying too much attention. I mean, I've seen it going up. That was the first time I looked at like a 5-year chart to see just how insane that was. So, on this one, what are you protecting to? You're probably looking at like, in this kind of thing, I'm sort of like, I'm comfortable with any pullback down to like, let's say like 525. Below that, if this thing started challenging 500, I would start to get nervous, right? You would get nervous. So let's look at again, a February put spread. So this is, let's go lower on this. So let's go down to like 564. I don't love that one. So let's go 564.90. Okay. So see it on the chart. This might be better to see on the 5-year chart. This protects you down to like this level. On the 1-year chart, it's kind of like if you got a breakdown of this recent consolidation, which has had the stock anywhere from 600 to 525, let's say, this protection kicks in at 545 and protects you all the way down, basically below 500. So I would think something like this. It's not too expensive. You're risking 15. It's protecting you. It's protecting for 55 points of that move, and it costs you 15. And 15 is nothing in the stock. It's up 10 today. So.
Okay. All right, CC,
Yeah.
we'd be here until the close if we went through all these tickers. Another informative segment here. CC is going to be back next week with Josh to follow up on these scenarios. CC, getting a lot of great compliments here. Love your analysis. Check out Options AI. Use the code STNPMP to sign up. So thank you for joining us on this segment of Options AI.
Awesome. See you. Thanks, Joel.